So welcome back guys. In this new lecture we are going to continue with question number 78. There is nothing new in this question that we should be taking or learning. So basically what is given in the question is the returns of the security and the market for the 10 different periods. Security X return and the market return. What has been asked to you is to calculate the alpha and beta of the security. Now understand, beta of the security can be calculated through regression analysis and correlation analysis, and you can use both the methods here. My suggestion to you right now is to use the regression analysis. The only thing that you need to remember in order to calculate the beta here is the formulas of regression and correlation. So according to regression analysis, see, beta is equal to summation of xy minus n bar x bar y divided by summation of y square minus n bar y square. So what is x and what is y? X is this security and y is always market. So first of all you are going to create a column xy, multiply 4.6 with 3.2 and write down here, and do the same for all the numbers. The only difficulty here will be the mistake that you can do in the negative signs. So minus 0.5 into 0.3, the answer should be negative, whereas the minus 2.3 and minus 1.6, the answer should be positive. This is summation of xy, the total of this summation of xy. Then n means the number of observation, this is 10. Bar x and bar y, that means the average of x and average of y. Do the total of all the x and y and then divide it by 10. So you will get the bar x and bar y. Then comes the summation of y square. So 3.2 into 3.2 will be y square. The total of it will be summation of y square, which will come to this place. Then n means the 10 and bar y square, this average of the y square. You will get the beta. Once you reach at this particular beta part, you can find out the alpha as well. Now, where do you think you have learned about the alpha? Alpha is discussed by us in securities characteristics line. What is the securities characteristics line? It is based on the single index model, and we can calculate alpha as Ri is equal to alpha I plus beta I Rm. This is Ri, the return of the security, Rm, the return of the market. Beta has been calculated here. So all the three figures in this equation is there with you. You can easily calculate the alpha. Rest all is a part of the practice and avoiding the mistakes in the calculation. So that's what you have to do. There is no point me discussing all the calculations now. So please make sure that you are doing the practice. Xy, y square, this is summation of xy. This is summation of y square. This is bar x bar y. That means you can call it as Ri, Rm also. And then this is beta according to regression analysis. According to single index model or securities characteristics line, Ri is equal to alpha I plus beta I Rm. So this is your formula. Now what does that mean? 1.066. If the market return goes to 10% above, the securities return will be 1.066 times 10%. That's 10.66%. Okay. What do you mean by the alpha? It is negative. Negative means our actual return, or let me write it in full, our actual return is less than required return. By how much percentage? 0.39. So let's say the required return is 10%. 10 minus 0.39, or we can write it like this also. If the required return is 10.39%, the actual return is only 10%. That's why the alpha is coming to negative. The other way of calculating alpha is actual return minus required return. Required return can be calculated through CAPM method. Okay, but not in this case. That is the different. This required return can be calculated using different theories. One is CAPM, second one is APT, third one is securities characteristics line or single index model. And we have used the third 1 because of the data given in the question. For CAPM, you need risk-free rate of return. Do you have the risk-free rate of return in this question? You cannot use this because of the risk-free rate of return, which is not given in the question. You cannot use this because of the risk-free rate of return. And that's why we have used the single index model. So there is no vague answer for using this model. There is a proper answer. CAPM and APT consist of risk-free rate of return, which is not given in this question. Okay, question number 79 now. It is also the same thing. Let's have a look. The rates of return on the security X and the market portfolio, we can say Y, is given to us. For the 6 different periods, the 6 different returns are there. Okay, it is for 10 different periods. It is the same as the previous question. We have to calculate the beta. Again, we can calculate it by the regression analysis method. You can use the correlation analysis also. Summation of xy minus n bar x bar y divided by summation of y square minus n bar y square. This is what the formula is. Repeat the process. Now characteristics line of security X. How do you calculate the characteristics line? Whenever they say calculate the characteristics line, you have to create a formula. You don't have to come up with a particular answer. See, in the previous question, they asked us to calculate the alpha directly, not the equation. In this part, they are asking us to calculate the equation only. Alpha and alpha plus beta I Rm. This is what the equation is. Ri is equal to alpha I plus beta I Rm. Now you tell me what will be the equation. Beta you can take from the first part. Beta you can easily take it from the first part. And alpha can also be calculated using the data given to us. See, alpha we have already calculated in the previous part also, right? With the same figure we can calculate the alpha as well. And then we can create a formula. So let me just find out what is the beta. You will have to repeat the process. Okay, in this question they have used the correlation analysis method. You can use the regression one also, the answer should be same. Let's take the beta as 0.505. See, there are two answers, Rm, Rx. Okay. Which is 15 and 12%. So how are we going to 15 and 12%? Calculate the securities characteristic line. This is 15 is equal to alpha I plus 0.505 into 12. Am I right? Right. So you can calculate the alpha with this figure. What is alpha? Minus 9. Sorry, 9%. So alpha is 9, beta is 0.505. What is the securities characteristics line? This is not the final answer, sir. The securities characteristics line will look like this. Ri is equal to 9 plus 0.505 Rm. So this is the equation or the formula where the two factors are constant and the other two are unknown variable. Given the rates of return of the market in the new data, you can calculate the stock's return. See. 0.506. See, there is a little difference in the rounding off. My answer was 0.505 in the previous part. 5.5. If you take 0.505, it will come exactly to 9. 0.505, 12 into 0.505. Okay, there is little difference in the answer. This will come to 8.94. And this will also be 8.94. 0.06 is the difference. So yeah, 0.506 or 0.505 and 8.94 is the alpha. Now the characteristics line will be this one. Ri is equal to 8.94 plus 0.505 Rm. That means two figures are constant and the two will be unknown. Line, calculating the line or deriving the line itself means deriving a formula, ending up your answer with a formula. That's it. Okay, this is another question. Returns on market portfolio for period of 4 years are as under. So this was the previous question was the period of 10 years and the answers was given using both the method, regression and the correlation analysis. So you can use any one of them. whichever suits you. I will suggest you one thing: whenever the probabilities are not given and the answers are given like that, the data is given like this, use regression analysis. It will, uh, we can say, reduce your time. Question number 80. Again, the return of the stock and the market return is given to you. You can take it as X and this one as Y, and these are given for the 4 different years. What has been asked to calculate is the characteristics line. Now please understand, for the characteristics line you need Ri is equal to alpha I plus beta I Rm. Now you will have to first calculate using regression analysis or correlation analysis the beta, and then you can calculate the alpha as you did in the previous question, and then you can find out the securities characteristics line. See, this is what they have used regression analysis, and they found the beta as 0.74, and later on they used the same formula to find the alpha as 3.69, and then they put it in the same equation. Ri is equal to alpha I plus beta I Rm. Our alpha was 3.69 with the previous data and 0.74 with the beta. So Rm Ri. This is your final securities characteristics line. Do you agree with this thing? Answer to the characteristics line. Now let's focus on the systematic risk and unsystematic risk. Whenever the question asks you about the unsystematic risk, you need to first understand that they have been asked us to use the single index model or Sharpe's index model. According to the Sharpe's index model, there is a formula for total risk, which is standard deviation of I square, that means variance or total risk, is equal to systematic risk, which is represented as beta I standard deviation of m square, plus unsystematic risk, which is ei square. Now they are asking us to calculate two things. The first one is this and the second one is this. Let's first calculate the third part, which is the total risk. Can we calculate the total risk? Yes sir. Total risk can be calculated with this formula. The basic formula that we have learned in the very first or second question of the portfolio management chapter. And it's very simple. In this question, in place of the stock, they have used Y, not X. X has been used in place of the market. So that's why I'm going to take Y for the stock. So Y minus Y bar, this is what will give us the deviation, because we want to calculate the standard deviation. This is the deviation, Y minus Y bar. To remove some negativity, we will square all the terms. And then since probability is not given, we are going to total it and then divide it by n. This will give us the total risk. Let's do that first. It's very simple, sir. Y minus Y bar. Y minus Y bar will give you the deviation. In order to remove some negativity, we are going to multiply. We are going to do the square of all the items. This is Y minus Y bar square. Then we are going to do the total 45. Then we are going to divide by n. N 45 divided by 4. The answer is 11.25. What is this 11.25? Total risk of the stock. 11.25. Now the only thing that we need to do or find out is the systematic risk, which is nothing but beta I standard deviation of m whole square. We have already calculated the beta here, 0.74 in the first part. And then standard deviation of m square. That means we have to calculate the market standard deviation as well. Market return is denoted as x. So x minus bar x. Then in order to remove the negativity, do the square of x minus bar x, do the total of it, and then divide it by 4 to find out the market variance. The market variance will be 19.25. 19.25. So systematic risk can be calculated as beta 0.74 square. Am I right? 0.74. And standard deviation of m square is already given to you. Lots of people will make this mistake. They will write 19.25 square. No sir, 19.25 is already in square. We don't have to do the square again. Now we are going to get the answer. That's 10.54. So understand, the total risk was 11.25. the total risk was 11.25, out of which 10.54 is the systematic risk. Can I say the balance is the unsystematic risk, which comes to plus 0.71? Simple. See, total risk, this is the first part, second part and third part. Total risk 19.25, 10.54 is your systematic risk, and the unsystematic risk is total minus systematic, which comes to 0.71. Got the answers? Very easy, using single index model. Practice makes man perfect. Question number 81 is your homework now. It is similar characteristics line and the systematic and unsystematic risk, asked in June 2009 for 8 marks. Years back. We have to solve this in the same manner. First we will calculate the beta using regression analysis. Then we will calculate the alpha using single index model or sharpest index model. Then we are going to find out the equation of line that we wanted. After that, the total risk of the stock and the market. This is standard deviation of M, this is standard deviation of the stock, and that too in variance. This is variance, this is variance. Systematic risk is beta I square, which will be 1.202 square, and standard deviation of M square already 14.14. And unsystematic risk is the total minus systematic. That's the very easy. So this is all about the betas and alphas that we wanted to learn. See, let me just come to the concept sheet. If we go through the concept sheet, we will understand that the 78th question was on alpha and beta of the security. 79th was on the market line, which is securities characteristics line. Then 80 and 81 is nothing but securities characteristics line and unsystematic and systematic risk. So there is one correction that you need to do in the concept sheet. It is not line. That's just a mistake by the designer that he has copy pasted that line word. It should be risk. So what I do is, most of the time I do this marking on the top left corner of every page, so that after the batch is over, I'm going to turn every page, and wherever I will see the marking, I will look at where is the mistake in the part, and I will improve that in the next edition. So in the next edition, it is going to get improved a lot. So question number 81 we have finished. Now only 14 questions are left in your syllabus of the portfolio management chapter. Out of that, these 4 questions are based on the single concept that we are going to learn, which is called as portfolio evaluation measures. This is an interesting concept that we are going to learn. So on the next maybe half an hour or 1 hour, we are going to spend on these 4 questions, learning portfolio evaluation measures. Let me take a break and I will be back with the concept. Okay, so welcome back everyone after the break, and now we are going to discuss about the portfolio evaluation measures. We have come a long way in the portfolio management chapter and have discussed lots of things. Now this is going to be another concept where we are going to learn about the results of the decisions that we have taken. Let me just write down. Portfolio evaluation measures. So there are 3 types of evaluation measures. The first one is the Sharpe ratio. Sharpe is ratio. The second one is the Trainer's ratio. These are different people. And the last one is the Jensen's alpha. Okay, what is that what is the formula of these 3 ratios? Let's first write it down and then we will discuss. Sharpe's ratio is all about Ri minus Rf divided by standard deviation of I. So understand the meaning of the formula, what exactly they want to talk about. Sharpe's ratio says that what is the extra return that you are earning as compared to the risk-free rate of return. Let's say, for example, 12% is the return on your portfolio or your asset or your share, and the risk free rate of return was 5%, or let's say 4%. So the extra that you are earning as compared to the risk free rate of return is 8%. And can I say that this was the risk free? We were not bearing any kind of a risk when we would have invested in risk free security. But if we have invested in the stock, it means we are incurring some, or incurring means bearing some kind of a risk. So from zero risk to risk, from zero risky investment to risky investment, we are getting 8%. And that risk is called as the standard deviation. So if the standard deviation of that stock is 4%, can I say that I am receiving 8% premium, or uh, I have 8% extra return on this stock for 4% of the standard deviation? This entire ratio will give you how much extra that you are earning per unit of standard deviation. For 1% of standard deviation, how much is the premium that you are receiving? For 1% of the standard deviation, how much is the premium that you are receiving? 8 by 4, which will come to 2%. 2% is the premium that you are receiving for 1% of standard deviation in risk, for 1% of the risk in terms of standard deviation. That's it. So if you calculate, please tell me one thing. If you calculate the Sharpe's ratio on 5 different securities, it will give you the premium that you are earning for 1% of standard deviation. Higher the premium, better will be the choice. So we are going to choose those stocks with a higher Sharpe ratio because they will give us higher premium for the same level of standard deviation. We are going to look at this part in the questions that we are going to solve in the coming time. Now the ratio. Trainer ratio is exactly equal to the Sharpe's ratio. But the only debate the trainer makes is that he is not satisfied with the fact that we are comparing this premium with per unit of standard deviation. Trainer says that this is the measure of a total risk, and this includes systematic plus unsystematic risk, right? Trainer says that this includes systematic risk plus unsystematic risk, and this risk is something which can be eliminated through diversification. Unsystematic risk is in the hands of the investor, and diversification can eliminate or reduce to a maximum extent this risk. So the only risk which cannot be reduced is the systematic risk, which is not in investor's control is a systematic risk. So it's better to evaluate the premium that we are earning for taking the risk on per unit of systematic risk basis, not the total risk. So the formula for trainer's ratio goes like this: Ri minus Rf, numerator is same, divided by beta I. Instead of taking the total risk and considering the premium on standard deviation basis, it's better to take the decision on per unit of systematic risk basis. So this is Ri minus Rf divided by beta I, the premium per unit of beta. So if the beta of the company is, let's say, 2.5 and premium is 8, 12 minus 4, 2.5 is the beta, the answer that we are going to get is 3.2% of premium we are getting for bearing a risk of 1 unit of beta. So this is exactly the beta of the market. So if we take the risk exactly equal to the market, we are getting 3.2% by investing, 3.2% extra by investing in the stock. The market premium RM minus RF should be maximum this much. If the market premium is higher, it's not worthwhile to invest in the stock, because market also, let's say for example, RM minus RF is 4%. Now this is also the premium for 1 unit of beta. Would you prefer to invest from RF to RI or RF to RM? Obviously you would want to go for market return, because for 1 unit of beta you are getting 4% extra return, and for the 1 unit of beta you are getting 3.2% extra return if you invest in the stock I. Getting it? So the strainer ratio explains the premium per unit of beta. This is the Sharpe ratio, this is the trainer's ratio. That's it. Sharpe ratio has a basis of standard deviation and trainer ratio has the basis of beta. That's it. Both the things are simple. Now, Jensen's alpha. Jensen's alpha. Remember the word alpha, and I told you how to calculate the alpha. Alpha is nothing but the actual, or we can say expected return minus required return. It can be calculated using capital asset pricing model, arbitrage pricing theory, single index model, any kind of a theory. Basically, it should be a theoretical return. It should be a theoretical return. This theoretical return will explain that if we are investing in a particular stock, let's say I, alpha I, then how much we should receive. So let's say theoretical return comes to 15%. That means we should get at least 15% by investing in the stock I. And if we are expecting that we will earn 18%, then 3 is the alpha. If we are expecting that we will earn only 12, let's say 13%, then minus 2 is the alpha. Positive alpha means we are earning more than required. Negative alpha means we are earning less than required. Okay, this is how the trainer's ratio, Sharpe ratio, and Jensen's alpha is. These are the portfolio evaluation measures. Given different types of stocks, you can calculate Sharpe ratio for each of the stocks. Higher Sharpe ratio is the better. The security with higher Sharpe ratio will be better. Higher Sharpe ratio represents higher percentage premium for 1% of standard deviation. This will change, this will remain same for all the securities. Trainer ratio, higher trainer ratio, higher the security with higher trainer ratio gives you the best answer or the better answer, a good opportunity to invest in high premium investment security. So 3.2% premium for 1 beta. This 1 beta will remain same for all the securities and the higher premium will be preferred. Also, Jensen's alpha. Jensen's alpha, actual return minus required rate of return. Higher the Jensen's alpha, better is your answer or better will be the decision. Because higher Jensen's alpha represents that you are expected to earn more, much more than required. So we are going to use these formulas in the coming questions. Have a look. Question number 82 in front of us. The following are the data on 5 mutual funds, and this is going to be very easy. A, B, C, D, E, 5 mutual funds. Returns are given to you. This is going to be actual return. RI. This is RI. Standard deviation of I and beta I. Okay. You are required to compute reward to volatility ratio. Please understand. This is another meaning. Reward means RI minus RF. Okay, volatility can be standard deviation and can also be beta. Volatility means risk. Risk is the standard deviation is also risk. Beta is also risk. It depends upon if we are talking about the total risk or systematic risk. If we talk about total risk, that is standard deviation. Systematic risk, that is beta. Reward means RI minus RF. So understand the meaning. They are talking about RI minus RF and the risk ratio. RI minus RF and the risk ratio is nothing but the Sharpe and trainer's ratio. And rank these portfolios using Sharpe and the trainer's method. What is the Sharpe ratio, sir? RI minus RF divided by standard deviation of I. We have RI here. We have RF also, risk-free rate of return, and the standard deviation also. And then trainer's ratio. RI minus RF divided by beta I. Everything in this formula, everything required in this formula is given in our question. Have a look. And now what we are going to do, we are going to calculate the Sharpe ratio and the trainer ratio for all the securities. Let's do it here itself. So Ri minus Rf, 15 minus 6. Am I right? I am going to deduct 6 from all. 9, 12, 8, 6 and 10. Then 9 divided by 7. 9 divided by 7, 1.29. 12 divided by 10, 1.20. 8 divided by 5, 1.6. 6 divided by 6, 1. 10 divided by 9, 1.11. These are the Sharpe's ratio. Now, trainer's ratio. Again, the same figures 9, 12, 8, 6, and 10, but divided by beta now. So 9 divided by 1.25, 7.2. 12 divided by 0.75, 16. 8 divided by 1.4, 5.7. 6 divided by 0.98, 6.12. 10 divided by 1.50, 6.67. Okay, you calculated all the Sharpe's ratio and trainer's ratio. First of all, please understand the meaning of it. That is very important, because I don't think so formula is very difficult to learn, but what exactly you have calculated and what is the meaning of that. So let's interpret. 1.29% extra return, or the premium, or we can say reward, we are receiving for 1% standard deviation if we invest in the security A or mutual fund A. 1.20% extra return for 1% risk. 1.6% premium for 1% standard deviation. So all these are the premium for 1% standard deviation. That's what it is. Premium, or you can say reward, for 1% standard deviation. So in all the mutual funds, the risk is same, which is 1%. Now you have to choose which one will you go for. Obviously, the higher number of the Sharpe ratio would mean that better premium for the same percentage of risk. More premium for the same percentage of risk. So if we go for ranking, we are going to rank this first. Okay, sorry, 1.6 is there. First, second, third, fourth, and fifth. Am I right? If we go for the trainer's ratio, it's first. No, 16 is first. First, then second, third, fourth, and fifth. Okay. See, 7.2% of premium for 1 beta, 16% of premium for 1 unit of beta, 5.71% of premium for 1 unit of beta. That's it. Am I right? 23154. 23154 and 21543. 21543. Right. Let's go to the second part. The 5 portfolios of a mutual fund experienced following result during the last 10 years period. See, again there are 5 portfolios A, B, C, D, E. Average annual return, that is RI, is given. Then standard deviation is also given. Correlation with the market return is given. Now, do you know why the correlation is given to us? Because in the previous question, beta was directly given to you, and in this part they will ask you to first calculate the beta using correlation analysis. Beta is equal to RIM into standard deviation of I divided by standard deviation of M. The correlation is given in the last column. Standard deviation of Y is given in the column just before that, and standard deviation of M is also given. Market risk, standard deviation of M, this is RM. So every figure is given. So first calculate the beta with that. Okay. Risk-free rate of return. Beta may be calculated only up to 2 decimals. Please understand, this is very important. Lots of students make this mistake that they forget or they just ignore such sentences and they end up writing the betas in 3, 4, 5 excuse me, decimals. Don't do that. Rank the portfolios using Jensen's alpha method. Now, what is Jensen's alpha? Actual return given in the second column minus your required return. Now this can be calculated using CAPM, APT, single index model, or any, for that matter, any particular theory. In this question, the data for CAPM is given to us: risk-free rate, market rate, and then the correlation data beta. Okay, so for this purpose we have to find out risk-free rate plus beta in bracket market rate minus risk-free rate. Now beta is not given to you in the question, we will have to find that out. So R I M, standard deviation of I, standard deviation of M. Use this formula first to calculate the beta of all the 5 portfolios. Put that beta in this equation, calculate the required return of all the 5 portfolios, and then compare that with the actual return. So actual return minus required rate of return will give you the Jensen's alpha. Higher the alpha, higher will be the rank. Okay, so this is first portfolio beta, then required, this is second item, CAPM for all the securities. This is the beta that we have calculated. This is this required rate of return. See, never do such a mistake in an exam. What they have done is, first they have written the required rate of returns like CAPM return in the first table, last column, and again they have written it here as well. Why to repeat the process and waste your time? You can easily understand, you can frame all the answers in one big table, which is okay for the copy or for the answer sheets as well. See, what should be the column? First of all, you will write down portfolio. Okay, then directly write down beta. Don't write the given details which is there in the question. Don't write it right now. So beta is equal to RIM, standard deviation of I, standard deviation of M. Make sure you solved all the betas, not just on the calculator, but write all the RIM, standard deviation of I divided by standard deviation of M figures in this column, and you will get some answers. Okay, then immediately calculate the CAPM return. RF plus beta in bracket RM minus RF. Then write down the actual return and then Jensen's alpha and then the rank. This much should fit in your one table. Otherwise you can continue the table below the first one as well. Continue it. So this is how it is going to be presented. See, our actual return was 20%, required was 17.25. They have written it as expected return, and you might ask that, sir, you have given us the formula of actual return minus required return or expected return minus required rate of return. But you need to understand the concept. This expected return is nothing but the required rate of return in this question, because this has been calculated using the CAPM method. Okay, since actual is already given to you, if you are writing expected, I would prefer to interpret it as required rate of return. Okay, higher the alpha, better it is for your investment. Okay, so C security or the portfolio C is giving us the highest alpha. That means our requirement is 13, but it is giving us 18%. So it's good to invest in that. If you have to choose any number of portfolios to invest in this from this list, which one would you reject? I will reject portfolio E because I'm expecting 13.71 and it is giving me only 13.5%. So it doesn't make sense investing a single rupee in portfolio E. In spite of that, instead of that, what you can do, you can invest that amount in any of the other portfolios. Let's move on to the next question now. This is again interesting, and now in this question we are going to calculate all the three measures: Sharpe's ratio, Trainer's method, and Jensen's alpha. Have a look. Again, there are 5 portfolios: A, B, C, D, E. So this is the third question where you are seeing lots of similarities in the question. So I'm going to move fast from in this question as well. This is the return, actual return given to us. We will write down as actual return, okay, or we can say RI. Now this RI and then RF is 9%. We can just deduct, see, this is RI or actual return. 9% is the risk-free rate of return. When you deduct 9% from it, the numerator for Sharpe ratio and Trainer ratio gets ready. So this is 10, this is 6, this is again 6, 17.5% minus 9, so 8.5 is 8.1. So okay, this is your numerator for the Sharpe's ratio. When you divide the numerator with the standard deviation of the portfolio, you will get the Sharpe's ratio. Okay, then the correlations with the market returns are given to you. The moment you see the correlation in the trainer or in the portfolio evaluation measures question, it means that they want you to find out the beta. Now beta can be easily find out or calculated by this method. Beta is equal to correlation of the security with the market into standard deviation of the security divided by standard deviation of the market, which is 14% here. No, not 14%, that's return. The standard deviation is 1.2. So how are we going to calculate? Sir, very simple. 0.840 into 2.5 standard deviation of the stock divided by 1.2 standard deviation of the market. 0.540 into 2 divided by 1.2 into 0.8 divided by 1.2 into 2 divided by 1.2 into 1.8 divided by 1.2. And you will have your betas ready. What to do with that beta? Sir, very simple. This RI minus RF divided by that beta will give you the Trainer's ratio. Then comes the Jensen's alpha. Jensen's alpha, actual return minus CAPM return. In this question, the required rate of return can be calculated through CAPM because beta is given to us, market rate of return is given, and the risk-free rate of return is also given. So apply CAPM method on each of the portfolios to find out the required rate of return. Deduct that return from this first column, 19, 15, 15, 17.5, 17.1. That will give you Jensen's alpha, just like the previous question. Okay, sir. This is portfolio beta. Beta has been calculated. Then CAPM return are also calculated. 17.75. This is called as required return. Now, they have directly mentioned the ranks, but it's better to calculate the ratios, show the calculation instead of directly putting the figures here 4, 3 and so on. Show the calculation in the first column and then the ratio and then the rank. So it's better to prepare 3 different table. Now in this part I am asking you to work which will take to prepare tables which will take more time than this one in exam, but that's a better method. So it's not like always I'm going to suggest you how to save the time in the exam, but sometimes investing your time for better marks is a good decision. Okay, can you calculate these ratios easily? Sharpe ratio, Trainer's ratio and Jensen's alpha. What is the formula for Sharpe ratio? Ri minus Rf divided by standard deviation of I. Trainer's Ri minus Rf divided by beta I. And Jensen's alpha, actual return minus required rate of return. This is required rate of return in this column. Actual returns are given in the first column. It's just the repeat procedure from the first 2 questions. Okay, let's move ahead. Nothing to learn about more in the previous part. Now this is going to be question number 85. Let's have a look whether we can learn something in this. The following are the details of the 3 mutual funds MFL. Average return is already given to us: growth fund, balance fund, regular fund, and then the last one is the market. Okay, so there are 3 types of mutual fund: first, second, third, and the last one is the market return. This is the return, this is the variance. Understand, this is not the standard deviation, this is the variance. So first you will have to calculate the standard deviation. Put a square root on all of them and you will get the standard deviation. Okay, then coefficient of determination. Have you understood? Coefficient of determination is the R square. It says how much is the beta reliable, how much is the beta of that stock reliable or that fund reliable. So 30%, whatever the beta of the fund is, 30% only is affected by the market. 65.61% of the beta is only affected by the market, and so on. R square, this is called as coefficient of determination. What are you going to do? You are just going to put a square root on all of them to find out R. Put a square root on all of them to find out standard deviation. That's it, because it's a variance given to you. Now since you have received you have now reached at the coefficient of correlation, you also have the standard deviation of market and the standard deviation of individual fund. You can calculate the beta easily. Now the yield on 182 days treasury bill is 90%, 9%. Treasury bill is for the risk free security. So rank the funds as per Sharpe's measure. See, average return as given in the question, variance as given in the question, put a square root on that, you will get the standard deviation. Coefficient of determination given in the question, put a square root on that, coefficient of determination. If this is R square, then coefficient of correlation is nothing but the square root of R square. So coefficient of correlation, see, coefficient of correlation and the two standard deviation will be taken from this, and the beta can be calculated easily. So we have calculated the beta for all the three funds. Now we only need RI, RF. See, what is the formula for Sharpe's ratio? RI minus RF divided by standard deviation of I. So we have all the figures. We have RF 9%, we have average return RI, and standard deviation of the stocks also from this column, this row. Then RI minus RF divided by beta I is the trainer's ratio. Trainer's ratio, RI, RF is available and the beta is also available. Then you are asked to calculate the find out the, or particularly rank the funds. Highest number of Sharpe's or trainer's ratio will get the first rank, and then in the descending order. Simple. Acha, how to interpret it? It's very simple, sir. See, Sharpe's ratio is negative 0.208, negative 0.405, negative 0.625. This is something different from the previous question. All the Sharpe's ratios are negative. That means we are earning less than the risk-free rate of return. Have a look. The risk-free rate of return is 9% and we are getting only 7% in the mutual fund. So we are losing 2% and also taking the risk of 9.60. That's a bad thing. So that's why the negative Sharpe ratio is always bad. 6% is the mutual fund return where the risk-free rate of return is 9%. We are earning less than the risk-free security. By taking the risk, earning less than the risk-free security is never suggested. Okay. Now, let's move on to the next part. Then this is going to be the trainer's ratio. Trainer's ratio are all negative here. The lowest trainer ratio will get a positive rank, because what is the worst trainer ratio in this? The highest number of negative figure will be the worst. So that's why 3 ranking is given to us. Okay, that's it. Now what is the third part? Compare the performance with market. Compare the performance with market. What does that mean? Compare the performance with market. You have to find out the Sharpe's and trainer's ratio of the market also. So instead of RI minus RF divided by standard deviation of I, you are going to take RM minus RF divided by standard deviation of market. This is the Sharpe ratio of the market. Again, RM minus RF divided by beta of the market, which is always 1. This is the trainer's ratio of the market. But unfortunately, 9% is the risk-free rate and 9% is the market return. So numerator will become 0. The final answer will become 0. 9 minus 9 divided by standard deviation of the market. 9 minus 9 divided by beta of the market, 1. Thus, the performance of the fund is very poor since all values are negative as compared to the market performance. See, market is at least giving 9% return. Market is at least giving 9% return. Sharp ratio of 0 is better. Understand? It is better. Trainer ratio of 0 is better than negative sharp ratio and trainer ratio. Do you understand this? What do you mean by the negative zero sharp ratio and zero trainer ratio? It means we are exactly earning, we are not getting the premium, but we are not losing anything. 0% is the premium for taking 7.60% of the market risk. 0% is the premium for taking 1 unit of the market risk. It's okay, but see here, you are losing 2.878% per unit of beta, 3.802% per unit of beta. We are at least not losing here for that unit of beta. So 0 is better than negative sharp ratio and trainer ratio. It ensures that we are at least earning equals to the risk-free rate of return. Negative sharp ratio and trainer ratio means we are earning less than the risk-free rate of return, and it is never desirable. In fact, 0 is also not desirable, but better than negative, right? Okay, question number 86 now. Have a look. This is going to be an amazing question where you are going to learn around 11 concepts in just a single question. So please make sure you mark it as important, very important. Why very important? Because you are going to learn lots of concepts in that. I will just take a break and I will be back with this question. See you. So welcome back guys after the break, and let's have a discussion on this. We are going to solve this question entirely from scratch. So Mr. Abhishek is interested in investing 2 lakh rupees, for which he is considering the following 3 alternatives. Mr. Abhishek only has 2 lakh rupees. He can invest the entire amount in mutual fund X, or he can invest the entire amount in mutual fund Y, or he can invest some amount in X, which is 1,20,000, and some amount in Y, which is 80,000. So if we calculate, it comes to 60% of the weight in X and 40% in Y. 2 lakh into 40%, it comes to 80,000. Okay, so basically we have 3 options: X, Y, and portfolio of XY. Am I right? Okay, sir. Average annual return earned by mutual fund XY is 15 and 14% respectively. See, let's start writing. Let's make the question easy for us now. X, Y, and portfolio XY. Okay, we can invest 2 lakh rupees here, 2 lakh here, or 1,20,000 and 80,000. 100% weight, it carries 100% weight, it carries 60% weight, and it carries 40% weight. Let's write down the returns. So the return for X is 15 and then 14 for Y. 15, 14, 15, 14. You know what are we going to achieve by multiplying the weights with the return? It is called as portfolio return. So it will be 9%, 15 into 0.6, 14 into 0.4 will be 5.6. Am I right? Right. So the total will be 14.6%. 14.6, the total return of the portfolio. So 15, 14 and 14.60 are the returns of our investment. Obviously, if we only consider the return on 2 lakh rupees, then I would suggest to you to go only with X, because it is giving you the highest possible return, and that's only return. We have not taken risk into consideration by now. Okay, let's move to the another data. Risk-free rate of return is 10% and the market rate of return is 12%. RF and RM is given. Now, the very interesting part to understand, covariance of returns of mutual fund X, Y and market. ignore this portfolio. It's not about the portfolio. It's only about X, Y, and this is nothing but market. Okay. So this is given in your in a matrix format. So basically this is nothing but covariance of X with X. Let me just write down. You can call it as covariance of X with X, covariance of X with Y, and covariance of X with market. That's the last column is of market. Then covariance of X with Y, Y and X. Then covariance of Y with Y and covariance of Y with market. Then covariance of market with X, or we can say XM, X with market, covariance of Y with market, and covariance of market with market. Okay, now understand few things in that. Do you realize covariance of XY and covariance of XY both are same, 4.3, 4.3. Covariance of XM 3.370, covariance of XM 3.370. Again, covariance of YM 2.8, covariance of YM 2.8. So three figures are repeated. Good. Now, can I write down one thing? What do you call covariance of X with X? Covariance of X with X is nothing but standard deviation of X square, that is variance of X. Because I will just tell you, let's write down the formula for correlation of X with X is equal to covariance of X with X divided by standard deviation of X divided by standard deviation of X into standard of X. Okay. Now one thing is very clear to us. The correlation of a particular stock with itself will always be 1. Because if I say Tata Motors is going up by 10%, then how much is the Tata Motors going up? The second security is also Tata Motors. That will also go up by 10%. So 10 and 10%, that means equal correlation 1. So it will always be 1. So covariance of XX is nothing but this denominator will go on that side and it will be deleted, and this standard deviation of X into standard deviation of X means standard deviation of X square is equal to covariance of XX. So can I say that covariance of a security with itself is nothing but the variance of that security, right? So this is the standard deviation of X square variance. This is standard deviation of Y square, and this is standard deviation of M square, that is market. Okay. Now, couple of more things. This is covariance of XM, covariance of YM, covariance of MM. Now, please understand, if I have to calculate, let's go step by step. This much is the explanation that I wanted to give you before starting the question, because understanding this table is the most important part in this question. Okay, let's find out. You are required to calculate variance of the return from X, Y and market. That means standard deviation of X square, standard deviation of Y square and standard deviation of M square, which is already given to you in the table. You don't have to do any kind of a calculation. The first part of this question is so easy that you just need to interpret the table properly to find out the answer of the first part. See, 4.8, 4.25 and 3.1. The first part's answer. Where is that? 4.8, 4.25 and 3.1. Are you okay with that? You don't have to write down anything. It's all about the data which is already given. 4.8, 25 and 3.1 alternatively. Now, the second part, portfolio return. Portfolio return, which we have already calculated, 14.60. 14.60. Let's write down step by step. First, covariance of XX. Sorry, they are asking us standard deviation of X square, standard deviation of Y square, standard deviation of M square. That means covariance of X with X, covariance of Y with Y, and covariance of M with M. 4.8, 4.2 and 3.1. Right? That's the first answer. Second answer, portfolio return summation. What is the formula for portfolio return? Weighted average. Ri weight I. That means Rx weight X plus Ry weight Y. We know return of the stock X, mutual fund X is 15, and the weight that we are investing in it is 60%. That is 1,20,000 rupees plus 14 into 0.40. That gives us 14.60%. Am I right? That's the calculation. Second part, portfolio return. After that, we need to calculate portfolio beta. See, portfolio beta is also weighted average summation of weight I beta I. That means weight X beta X plus weight Y beta Y. We know the weight of X is 60%, but we don't know the beta of X yet. Plus 0.40 into beta. So first we have to find out the beta of X. How do you calculate the beta of X and beta of Y? Tell me. It's very simple, sir. Beta of the X can it be calculated using regression analysis in this question? No, sir. No such data is given to us. But yes, covariances are given, standard deviations are given. We can use the correlation analysis method. Have a look. If we want to calculate beta of X, we need covariance of X with the market. Why just with the market? Because beta is always calculated against the market returns, not the other stock, divided by standard deviation of M square. Covariance of Ym divided by standard deviation of M square. Do you know standard deviation of M square is this? 3.1. Let's put the figures first. And can we find out covariance of X with M from the table? Yes, sir. Y with M from the table? Yes, sir. These are the two figures. .37 and 2.8. See, covariance of X with M, covariance of Y with M. Already 3.37 and 2.8. So 3.370, 2.280. Let's find out. 1.087. Did they ask anything else? No. Okay. 2.280 divided by 3.10. Let's put the figures. 0.735. So this is the beta of both the X and Y. Let's put that in the equation. 1.087 and 0.735. You will get the answer. Point 946, or you can say 0.95 as well. So this is the portfolio beta. Then portfolio variance. Do you know how to calculate a portfolio variance? What do you call as portfolio variance? It is nothing but standard deviation of P square. Am I right? Having two securities in that. Do you know the formula for that? A portfolio variance with two assets in that. The very first initial formulas that we learned, it's nothing but standard deviation of X weight of X square plus standard deviation of Y weight of Y square plus 2 into weight of X weight of Y and RXY or we can write down standard deviation of x, standard deviation of y are xy. And in fact, in place of this much of the data, we can write down covariance of x with y. We have that figure in the table. So we have all the figures here. Let's write down. See, we already have standard deviation of x square, standard deviation of y square. So I will write it down like this. Understand? What is the standard deviation of x square? 4.8. So 4.8 into 0.60 is the weight of x in the portfolio square, plus standard deviation of y square is 4.25. 4.25. Never make this mistake of squaring this figure again. The 4.8 and 4.25 are not the standard deviation, it's already in the variance format. Into 0.40 square plus 2 into 0.6 into 0.4, and let's find out covariance of xy. Can you see it here? Covariance of xy 4.3, x and y column. So multiplied by 4.3. Let's solve this matter. 0.6 into equal to into 4.8. That's 1.728 plus 0.40 into equal to into 4.25. 0.68 plus 2 into 0.6 into 0.4 into 4.3. That's 2.064. So 1.728, 0.68, 2.064. 4.472 is the portfolio variance. Okay. Next figure is the standard deviation of the portfolio, which is nothing but the square root of the variance. 2.115. This is your fourth answer. So 4 answers of the second part. First, the portfolio return, portfolio beta, portfolio variance, and portfolio standard deviation. Let's check the answer if there is any mistake by us in the calculation. 14.60 portfolio return. Then portfolio beta is 1.013. That's a mistake from our side. Where did we make the mistake? In the calculation of beta y. Let's just check that once again. Ym 2.280 divided by 3.1. It's 0.735. No. Let's find out the same in the table. Yeah, it's Ym, covariance of Ym 2.8. Okay. Okay. That's a mistake from my side. A small mistake. It should not be 2.280. It was 2.8 only. So that made all the difference. I will just correct my answer. 2.8 divided by 3.1 is 0.903. Let's just keep that here and change the answer. 0.903. So it will be 1.013. This is your portfolio beta. Okay. Then portfolio standard deviation 4.472. This is the portfolio standard deviation, and 2.115 portfolio variance and the portfolio standard deviation. Variance and the standard deviation. Are you okay with this? These are the 4 answers. In the second part, they asked everything about the portfolio X and Y. This third part, in the second sub question, they asked about this portfolio. Calculate the return of the portfolio, calculate the beta of the portfolio, calculate the variance of the portfolio, and calculate the standard deviation of the portfolio. Okay, what's more in the next part? Now we have to calculate the expected return. See, the average annual or actual return is already given. and the portfolio return was already calculated. If they are asking us the expected return, I will surely say they are asking us the required rate of return, which can be calculated in this question by CAPM. See, required return or expected this return can be calculated using any theory provided the data for that theory is given. Let's say a single index model. Do you think alpha is given in this question? So we cannot use the single index model. Arbitrage pricing theory. Do you think the various factors are given in this question? No. So we cannot use the arbitrage pricing theory. CAPM. RM is given to you, RF is given to you, and betas are also calculated in the second part itself. So we can use CAPM to calculate the expected return of all the three, X, Y, and portfolio. Have a look. The third part. Expected return. In bracket we will write down CAPM. So this will be RI is equal to RF plus beta I in bracket market return minus risk-free rate of return. So this is going to be RX, RY, and R portfolio. We are going to calculate the required rate of return for all these three. And the only difference in all the three formulas will be the beta, because RM and RF will be same for both. What is the RM and RF? Can I say RF is 10% and RM is 12%? Right. So 10, 10, 10. And 12 minus 10, you can write down 2 directly if you are smart enough. Let's write down the betas of all the three. So beta of X is 1.087, Y is 0.903, and the portfolio is 1.013. 1.087, 0.903, 1.013. Am I right? Okay, let's go ahead and find out the answers. 2 into 1.087 plus 10, 12.174. 0.903 into 2 plus 10, 11.806. 2 into 1.013 plus 10, 12.026. These are the required rate of return for all the three investments that we are considering. First part. Then the second part, systematic and unsystematic risk. The moment unsystematic risk is written, that means we have to think about the single index model. Now, total risk, write down the equation first. Total risk, or first we will write down according to Sharpe's index model, total risk given in the standard deviation of I square format is equal to systematic risk, or we will write down the formula below this. Systematic risk plus unsystematic risk. Now let me tell you one thing. They asked us to calculate the systematic and unsystematic. Total risk is already calculated by you. I will just show you. Systematic is what you have to calculate, and then deduct this systematic from the total risk to arrive at the unsystematic part. Let's start. Standard deviation of I square is equal to beta I standard deviation of m. So I will write down beta I square standard deviation of m square. Everything is in variance, plus EI square, error term. Okay. Standard deviation of x square is equal to beta x square standard deviation of m square plus EX square. Am I right? So what is the beta of x? Okay. Let's first write down the total risk of all the three. It's better. Total risk. Standard deviation of x square, standard deviation of y square, standard deviation of portfolio square. See, the three investment that we are considering is x, y, and portfolio. What is the standard deviation of x square? 4.8. Y square 4.25. So 4.8, 4.25, and the portfolio variance we just calculated in the previous part, which is 4.472. This is the total risk. From this risk, we are going to deduct the systematic risk. Now, let's calculate the systematic risk. Beta x square standard deviation of m square, beta y square standard deviation of m square, and beta p means the portfolio square standard deviation of m square. Isn't that easy? Okay, so beta of x 1.087 square, and the market's variance of the market standard deviation of m square 3.1 into 3.1. Do not do the square of 3.1, it is already in square format. Then 0.903 square into 3.1, 1.013 square into 3.1. Am I right? So this is where you have to be very careful that which figure is already in the square format. Let's find out the systematic risk. 3.663, 2.528. Please understand the chronology. We should already know that the total risk is in 3 decimals. So the systematic risk has to be stopped at the 3 decimals only, so that we get a proper answer. 2.528, 1.013 square into 3.1, so 3.181. Now what all you have to do is you have to deduct this systematic risk from the total risk to arrive at the unsystematic part. And 181. For x, error term x square, error term y square, error term portfolio square. (4.80 minus 3.663), 4.250 minus 2.528, and 4.472 minus 3.181. (1.137), 1.722, 1.291. These are the 3 answers. Let's check that in our working. First of all, expected return 12.17, 11.81 and 12.03. 12.17, 11.81 and 12.03 in 2 digits. Then systematic risk 3.663, 2.528 and 3.181. 3.663, 2.528 and 3.181. 1.137, 1.722 and 1.291. 1.137, 1.722 and 1.291. It's very easy. So can you see we are covering lots of concepts in this entire single question. Now the last part of this question asks us to calculate the Sharpe ratio, Trainer ratio and Jensen's alpha for all the 3 investment X, Y and portfolio. Let's find out fast. Fourth part, Sharpe's ratio. What is the formula for Sharpe ratio? Sir, Ri minus Rf divided by standard deviation of I. So Sharpe ratio for X, Sharpe ratio for Y and Sharpe ratio for portfolio. So what is the return of security X? It's already given in the question, 15%. 15% is the return of security S, risk-free rate is 10%. 14% return of the security Y, risk-free rate 10%. What is the portfolio return that we had calculated in the beginning? It was 14.6%. So 14.6 minus 10 divided by, what do you think will come in the division? Standard deviation. But what is given to us is the portfolio standard deviation square. So we have to put a square root around this. 4.8 square root, 4.250 square root. Square root of 4.8, square root of 4.25. Okay, and the portfolio standard deviation was already calculated. We can just directly put this 2.115. Let's find out. 4.8 square root divided by equal to, so I brought that in the numerator, multiplied by 5. The answer is 2.28. And then 4.25 square root divided by equal to into 4. The answer is 1.94. Then 4.60 in the numerator divided by 2.115. The answer is 2.17. These are the Sharpe ratio. Let's find out the trainers. What is the formula? Ri minus Rf divided by beta I. So let's do that for X, for Y, and for portfolio. 15 minus 10 divided by beta of X, 14 minus 10 divided by beta of Y, and 14.60 minus 10 divided by beta of the portfolio. Beta of X 1.087, 0.903, beta of Y, and the beta of portfolio is 1.013. 1.087, 0.903, 1.013. Let's find out. 4.6, 4.43, 4.54. This is the trainer's ratio. 5. Okay. Then comes the Jensen's alpha. Actual return minus, in this part, when we say required return, we are properly going to write it as expected return. Why? Because the CAPM return was calculated as an expected return in this question, in the third or second part. So let's take the actual return, 15 for X, Y, and portfolio, 14 and 14.60. These are the actual return. What are the required return? These are the required returns: 12.174, 11.806, and 12.026. Let me just check once again. 11.806, 12.026, and 12.174. Okay. 2.826, 2.194, 2.574. So this is the extra return that you are earning more than expected. You expected only 12% from X, you are earning 15. You expected 11.80 from Y, you are earning 14. The expectation from the entire portfolio was 12 only, but you are earning 14.6. So positive alpha means you are actually earning more than required. Let's cross check these answers. First, let me put a 2.28, Sharpe ratio 1.94 and 2.17. 2.28, 1.94 and 2.17. Then 4.6, 4.43, 4.54, 4.6, 4.43, 4.54, 2.826, 194 and 574. 2.826 means 2.83, 2.19 and 2.57. 2.57 in two digits. So these are the percentages. Percentage. In fact, I will tell you, this is also in percentage and this is also in percentage. 2.28% for 1% of the standard deviation. 2.28% of the premium for 1% of the standard deviation. That's what the meaning is. Okay. So how many concepts that you have learned in this question? Let's find out. See, we have covered variance of the return. Okay, that's one concept. Portfolio return, portfolio beta, portfolio variance, and portfolio standard deviation. 5. Expected return, that means CAPM. 6. Systematic risk, unsystematic risk. 7 and 8. Sharp ratio, trainer ratio, and Jensen's alpha. All in all, 11 concepts asked in the question itself. Apart from that, covariance. Covariance. We learned about the covariance, then the formula of this correlation also. So couple of concepts were included in this itself. So this is going to be an amazing question for the purpose of revision. If you really want to revise, this is going to be like this one question can reduce number of questions for you for your revision. If you do it properly, that means lots of questions you can skip it. I will also issue important questions list where I will just reduce all the question where these formulas are used, so that this one question itself can be enough for you. That's great. This is going to be question number 87 now after a little break. Okay, so welcome back after the break, and this is going to be the last question of this lecture, I think. So let's have a look on this question. This is pretty easy question, not that big, but it is framed in a different manner. Remember that one question of car AC, window AC? We were actually considering those ACs as a number of share or different types of shares and the company as a portfolio. So in this question also something like that is there. Suppose that economy A is growing rapidly, some kind of economy, and you are managing a global equity fund that has so far invested only in developed countries' stock. So basically, you have only invested till now in the developed country stocks. But apart from that, there is one more developing country, economy A, which is growing rapidly. And you don't want to miss out on the opportunity of earning extra returns by investing in economy A. So there are two things, developed country stocks and stocks of economy A. Right now you have all the investments in developed country stocks only. Okay, now you have decided to add the stocks of economy A to your portfolio. The table below shows that the return, standard deviation and correlation coefficient. Have a look. Expected rate of return annualized for both, risk annualized for both, correlation coefficient between the two. Assuming that the risk-free rate of interest is 3%, you are required to calculate what percentage of your portfolio should you allocate to the stocks of economy A. That means they are asking you the weight of economy A in your portfolio if you want to increase the expected rate of return on your portfolio to by 0.5%. Okay, so first of all, you will have to understand or find out what is your current portfolio return. The current portfolio return is the return where you have invested, and right now you have invested only in the developed country stocks. So the return will also be only of the developed country stocks, that is 10%, and you want to increase that rate to 10.5. That means, right? So the new portfolio return should be 10.5%, and you are including both the developed country stocks and the economy A in your portfolio. The only thing that you have to find out is what is the weight of stocks of economy A in your portfolio, and that's very easy. Have a look. How do you calculate the portfolio return? First of all, portfolio return is equal to summation of weight I R I. Am I right? Weighted average. And in your portfolio, there are only two things. First is the developed countries stocks into return of the developed countries plus weight of economy A into return of economy A. Am I right? And this should be equal to 10.5%. Am I right? Also, please take this part. Let's take this entire part here. Also, let's say the weight of stocks of economy A, that's what we have to find out, that WA is WA itself, and return of the stocks of economy A given in the question is 15 plus. Can I write down weight of developed country stocks as 1 minus weight of A? Because there are only two things in the portfolio. If the economy A's weight is WA, economy D or developed country stocks will be the balance weight, which is 1 minus WA into 10%, should be equal to 10.5. Let's solve it now. 10 minus 10 weight of A plus 15 weight of A is equal to 10.5. This 10 will go on that side. It will be 5 weight of A is equal to 0.5 and weight of A is equal to 10%. So only 10% of your portfolio should be allocated to the stocks of economy A, and automatically your return will become 10.5%. 10.5%, the portfolio return. In order to reach at the goal of 10.5%, you have to invest 90% in these stocks and 10% in these stocks. So basically you have to shift your 10% of the funds from the developed country stocks to the stocks of economy A, and automatically the portfolio return will become 10.5%. Now the second part, what will be the standard deviation of your portfolio assuming that the stocks of economy A are included in the portfolio as calculated above, means 10% and 90% ratio. In 90-10 ratio, we have included both the companies economy A stocks and the developed country stocks in the portfolio. Now find out the portfolio standard deviation having two assets. Can we do that? Yes sir, it's very simple. Standard deviation of the portfolio square. Let's first calculate the variance and then we can just square it, put a square root to find out the standard deviation. And it's very simple. Weight of developed country stocks into standard deviation of developed country stock square plus weight of economy A, standard deviation of economy A square plus 2 into weight of D, weight of A, standard deviation of D, standard deviation of A, RAD. Am I right? Every figure is available with you. Just put the values in the equation and you will get the answer. 0.90 into standard deviation. The weight of developed country stocks is 90%. Standard deviation 16, 16 and 30. 16 square plus 0.10 into 30. See, you can clearly see the economy which is growing has a 30% standard deviation as compared to the developed country stocks, which is almost half of it. So 0.3 square plus 2 into 0.9 into 0.1 into 16 into 30 into, what is the correlation coefficient? 0.30. Let's solve this. 207.36 plus 9 plus 25.92. Let me just calculate it once again. 2 into 0.9 into 0.1 into 16 into 30 into 0.3. 25.92 plus 9, 207.36, 242.28. Standard deviation of the portfolio, a square root of this, which is 15.57%. Is this a good deal? Yes, sir, it's a good deal to include the stocks of economy A. I will tell you why. Understand one thing. Before and after situation. This is before and this is after. Let me just change the color so that this is before and this is after. Earlier, you had only invested in the developed country stocks whose return was 10%. Now, since you have included stocks of economy A, your return is 10.5%. It is better or not? Yes, sir, it's a good thing. Now, standard deviation. Earlier, the developed country stocks was having a standard deviation of 16%, and now the standard deviation has reduced from 16 to 15.57%. So in both the sense, return has increased, risk has decreased. So it's a good decision to include stocks of economy A. Okay. Now, also show how well the fund will be compensated for the risk undertaken due to the inclusion of stocks of economy A in the portfolio. Now, looking at the question, you can write anything as an answer. We can just say that, see, first of all, let's discuss the question. The question is very simple, very easily asking you that we have taken a higher risk of 30% in our portfolio. So, how well we are compensated with that extra risk which we have included in the portfolio. So compensated doesn't mean they are asking you to calculate the return. They are asking you to calculate the extra return for the extra risk that you have taken. So you can write down very easily that the extra return that you have achieved is 0.50%, and also the risk has reduced, not increased, because of that correlation coefficient thing, because of the diversification. So there can be multiple answers, and everyone can answer in a different format, because the question is not specifically asking something. So you may write your own statement, I might write my own statement, and both of them are particularly true. But the thing that is done in the solution is they have calculated something called as the Sharpe's ratio. And they are saying that the Sharpe ratio is improving by approximately this much percentage. Improving itself means that we have to find out the before and after Sharpe ratio. First question that comes to my mind or your mind is, sir, from where or which particular statement we will get to know that we will have to find out a Sharpe ratio only, because there is no such hint in the third part. And you are right. And that might happen that will happen in the exam. So my suggestion to you is, don't worry if it is given as Sharpe ratio. You can write your own statement also, and there are chances that you will get the mark, and there are chances that they will cut the mark as also, and you cannot help it, and there is no solution to that. Only thing that you can do is you give your best. Instead of keeping it or leaving that third part, it's better to write something. Getting it? So I'm not going to trick you with the question and tell you that, oh, you should know how to you should know the compensated word itself means Sharpe ratio and all that thing. No, it's not. It's a simple statement which is asking something very simple, and we can reply to that question in a simple language that yes, 0.5% is the extra return that we are getting for the higher, for including the higher risk security in the portfolio. And in fact, the portfolio standard deviation or the risk of the portfolio is getting reduced. So yes, we are getting compensated. But then let's go with this. This is what you can write down, but let's discuss this one also. Okay, now they have calculated the Sharpe ratio. So Sharpe ratio has a formula, Ri minus Rf divided by standard deviation of y. One hint that you can get from the question is they have given you the risk free rate of return 3%, and we haven't used it in the first or the second part. So obviously we can use it in the third part as well. And you might say that we can calculate the beta of the portfolio, but no, we cannot calculate the beta right now, because we don't have the correlation coefficient of this developed country with the market and stocks of economy A with the market. The correlation coefficient which is given in the question is between both of them, and beta cannot be calculated between both of them. Understand the fact. So beta is altogether eliminated. You cannot use the trainer ratio or CAPM also. So yeah, from this, if it comes to your mind, then well and good. Otherwise also well and good. We cannot help it to that. So let's calculate Ri minus Rf before situation and the after situation Sharpe ratio. What is the formula for Sharpe ratio? Ri minus Rf. So 10 minus 3 divided by standard deviation 16, am I right? And 10.50 minus 3 divided by standard deviation 15.57. Let's find out. Earlier, the Sharpe ratio was 0.4375. And now the Sharpe ratio is 0.4817. So you can clearly see there is an increase in the Sharpe ratio, which is a good sign. How much? It is an increase of 0.40442. By this much your Sharpe ratio has increased. That means for every one standard deviation, earlier you were getting this much of the premium. Now for every one standard deviation you are getting 0.48 as the premium. That means for every standard deviation the premium itself has increased by 0.04%, and that's how you are getting compensated. Okay, let's move ahead to question number 88 in the next lecture. This is going to be the largest question, or you can say the formula in it you will have to just mug up. This is the only question on that formula. The concept's name is optimum portfolio theory, and it's a theory, so there are some steps that we will have to learn. There are very less chances that it will come in exam, but if it comes in exam you should be able to do something at least. So we'll meet in the next lecture with this optimum portfolio theory question, and probably in the next lecture itself we are going to end up the entire chapter. Let's see.